All right, we're back for another episode of the YVR REMO show. Today we're going to jump into a real common question that's coming up. Have we hit the end? Are we at the turning point of the Canadian real estate market? And so there's a few things that we're going to hit on there. We did just want to quickly address just a bit of an update on the show and where we're at going forward. We have changed to every 2 week schedule. So if you haven't picked up on that, just a heads up, we are recording every 2 weeks now. And we're continuing to listen to feedback. So again, if there's anything you want us to touch on, please don't hesitate to reach out, whether it's messaging us directly on our socials, reaching out to us by email, whatever works for you. We're happy to hear it. And we're definitely willing to take that feedback and implement it into our show. So let's dive in. Today, I'm with Tyler Trompeter, Derek Williamson, and of course myself, Dean Lawton. Maybe let's just start with a quick summary of the events that have occurred recently. And I'll start off with just the Bank of Canada hitting pause on October 25th. Of course, there was no rate hike. It was the second consecutive decision to pause. And we've also had some other, good news stories in regards to the American market and whatnot. So I want to pass it off to Tyler. Maybe you can just touch on a few more items.
Sure. Yeah. I think if you're listening to this podcast, the theme is just we're going to, we're actually taking this from one of our blog posts that's going out. So if you're not receiving any of our other materials, we do put out we try and get out there maybe monthly, every couple of weeks, a Thrive Insights blog. And we kind of put this together and is it the turning point? Please don't timestamp us, don't barbecue us barbecue us if things change, because of course they can change. But the best stuff we can really act on is just economic news, because if we just ignore what's happened in the last couple of years, what moves interest rates upwards and downwards? Generally, economic news, either positive or negative. So why were interest rates ripping up the last couple of years? Inflation was ripping, the economy's ripping. And when the question we always get asked is when are rates coming back down? When are we going to get a pause and stop from the Bank of Canada and central banks around the world? It's when the economic news starts to deteriorate, roll over, the economy peaks and starts to go down, maybe towards something called the recession. So yeah, what have we seen recently? Dean hit it right on the head. A Bank of Canada pause, right? And there's been a few pauses in a row. Probably the biggest one, we won't dive too deep into why, because it's a whole big economic series that we couldn't even cover in one podcast, but why the Americans are the most important central bank in the world. They hit pause, right? If we looked at the Canadian inflation report that came out a couple weeks ago, it fell quicker than expected. There was a retail sales number that came out where basically they survey all the big wholesalers, and those numbers, the sales were less than they expected. The other big piece is employment data. Jobs, we added less jobs than we thought. Same here, and down the States, they had a massive revision where they're always going back and double checking, making sure if their numbers were correct, and there was a massive revision downwards. And what that means in the employment piece is that, some of the things the central bank's been really worried about is just the labor market, and is there just too much excess demand? Is the economy rolling too hot? And all of those reports seem to indicate, at least now, this is just a couple of reports now, it's certainly not a trend, that the economy is rolling over. So why is that important to you if you have a variable rate mortgage, or you have a mortgage coming up for renewal, or if you are considering buying? All that weak data should suggest that rates have hopefully possibly peaked and they're starting to come back down, and we're kind of starting to see that. So, why the weak economic data? Why are we seeing that now? It's because of rate hikes, right? So why did the Bank of Canada hike rates? Because they're trying to slow the economy. It usually takes upwards of 18 months for rate hikes to really bite. From the start of the rate hiking cycle, March 2022, we're now, I think, the 19th or 20th month in. So we're now just starting to feel the real effects of those rate hikes. Of course, if you work in the real estate industry, if you're a realtor or a mortgage broker listening to this, we've already felt the effects, and our businesses have suffered since, but now it's finally starting to hit the broader economy.
Yeah, really good points. And I guess from a, why does this matter perspective, obviously if someone's coming up for renewal, if you're in a variable product, these are all immediate, hopefully positive impact when we do see rates starting to come down. The other side of this, and this depends on where you're at and where you live, geographically, and Greater Vancouver, Fraser Valley, it's a pretty strong real estate market. And what we've always found is like when rates increase, the market slows down pretty drastically. And in different areas, as Alberta as an example, not necessarily the case. And I think that's tied to property values and mortgage balances and affordability in general. Like Calgary, as an example, is crazy busy right now, even with these inflated interest rates. Like that's not what we're dealing with here. So, for someone that's been sitting on the fence about potentially moving, upsizing, downsizing, buying a rental property, like what we typically would expect to see once we have some stability, and especially when rates start to decline, is the market will just take off again, which typically drives prices up. And, like right now, people looking to buy, like you don't really have that fear of missing out component of the market. And I think as soon as property values start increasing and that's kind of the message that's out there and there's multiple offers, it's just people rush in and they make quick decisions and, they're buying over asking price. So I guess just something to consider if you are on the fence about making a move. There's pros and cons to buying now and maybe taking a bit of a higher rate compared to, waiting and seeing that happen, right? Because then you're dealing with the fast-paced market and a lot of changes there. And
I think it's important to just also caution that we could see a blip back up and these numbers could reverse. I mean, we're, for all, when looking at all experts, most aren't predicting anything of that nature, but it is important to just understand that this could reverse. And we saw that to a degree in the earlier part of this year in March, where, we were thinking we were towards the end of the market and things did bounce back up. So just a piece of caution there, but we are very confident in these numbers and things are looking positive. So maybe, why don't we just kind of touch on that? Like, why the weak economic data?
Well, again, it's the higher rates, right? And so if we look at it from the mortgage broker side of things and real estate professionals type side of things, like when you hear the economic data and all this stuff, all this news reports like coming in softer and negative, like what happens? Bond yields start to fall. And why are bond yields important? Bond yields are what price the fixed rate mortgage market. So like all this is like to Dean's point, like it can pop up and down, like a lot of fixed mortgage rate pricing, something, bond yields, like a lot of this stuff is it's traders. It's like stock traders. It's a lot of like, it's basically like financially gambling, right? Like people are betting on direction of interest rates. And so when they hear this news is negative, people start pouring into bonds and maybe I'm going too deep into this, but it drives fixed rate pricing down. So it's kind of crazy to think about, but you need things to get worse for things to get better in the real estate world, because as the economic data gets worse, the pricing of your borrowing costs go down. So we're seeing, a lot of especially our non-bank lenders starting to drop their mortgage offerings, their pricing. Like we are seeing that happening. I mean, it's not, we're celebrating going from like, 7s to like just breaking the 6 threshold. That still might be a little bit, it's still probably high for a lot of people to wrap their head around. And we're not necessarily like popping bottles and celebrating over here, but it is a good positive direction considering what the last, 6 to 9 months has been, right? Where the rate direction's been only one way. And now, hopefully it's really starting to roll over.
Yeah, there's an interesting article actually. I just pulled it up. There was a survey that went out to 28 influential economists. This is in November. And the majority of them are predicting that there will be a 0.25% rate cut before April of 2024. They're also predicting that there will be a full 1% in rate decreases through 2024 and another 0.5% in the first quarter of 2025, which is, it's very positive. Again, there's a lot of these predictions out there. You could Google it and you'll get 15 different answers. But given, the amount of people involved in the survey, I think it definitely sounds pretty positive. If that is the case, I think that's great news all in all. There's other predictions suggesting that rates won't start to decline until the end of next year. So time will tell.
Yeah, time will certainly tell. So, what we can chat about right now in regards to an example is we have seen like a few rates drop. So like, why don't we just touch on what we've seen recently with First National Financial, which is one of our largest non-bank lenders in the channel, as of October 23rd. So we're talking about fixed rates here. The Bank of Canada, the prime rate has had no change. And what Derek was just mentioning was more so around prime rate changing. But given the fact that the bond yields have been falling, like Tyler mentioned, we do almost see an immediate impact to fixed rates when that starts to occur. And so I'll touch on that. So as of October 23rd, the 5-year fixed rate was around 5.94%, with First National. And on as of November 6th, that rate has already dropped to a point of 5.64%. So a 30 basis point drop. In other words, 0.30% drop. Pretty significant in really just a 2-week period of time to see that, because again, very positive because it's only been up and up in the last 6 months. So again, positive sign there. Really interesting example. Again, to Tyler's point, probably a lot higher than what most people are thinking or expecting, especially somebody coming up for renewal that was in a very, very low fixed rate. That could still be a very, very much a sticker shock type price point, but good news to see that drop, and we are expecting to only continue to see those types of drops as things progress in this direction. Another major example, which maybe Tyler you can touch on, just in regards to some of the major banks.
One thing we're doing actively, and we always do for all of our clients, is always try and get the file, your approval repriced after approval, because we're always watching these economic conditions, the pricing, metrics that set fixed mortgage rates. So there's something called discretionary pricing that banks offer, where they're going to approve you at rate A, but in the background they actually offer rate B, what they the rate they know they can actually offer as cheap as it can get. So we're seeing a lot of our our mortgages that we have approved get repriced. I mean, sometimes to the tune of 0.75%, which may not mean a lot to you, but that's a massive change and a huge amount of savings for our borrowers. So what that tells us from our side of the fence is okay, there is a lot of room for these rates to come back down if they're getting that competitive. And we're hearing it from our bank partners all the time, right? And this is where a good mortgage broker who's plugged in, who's looking at this type of stuff, isn't just selling you bank product. They actually understand the reasons why mortgages get priced this way. Our banks are coming up to us and just say, hey, we know this is what our rate is, and this is what we've offered you, but if you're going to move this somewhere else, please let us know. We don't want to lose the deal. And quite often we'll be able to try and match what you're going to get elsewhere, which to us is great. I mean, if we don't need to move it somewhere else, it just saves everybody a lot of time and effort. And it's also a good point to mention, if you're listening to this and you have an approval or you have a renewal coming up, or someone's got a rate in front of you, you should probably shop that or go back to the source who got that to you and just say, hey, from what I understand, bond yields are down. Is there a way to get this mortgage rate down? Because really, this is the time to be doing that kind of thing.
The huge point of this too is the lender that you're working with or the lender that your broker's working with, not all lenders will drop their rate, right? Even if bonds tank tomorrow, there are a ton of lenders that if we went to them and said, hey, bonds are down, what can you do? Can you get the rate down? Most of them actually don't have the ability just to drop the rate. So that really depends on what institution you're working with. A lot of the big bank type institutions have a lot more flexibility on this. And again, I guess just the importance of working with the right lender and making sure that your broker's all over any potential for rate discretion or drops before completion. Okay,
so with that said, let's just play out a scenario here for a second. We've been talking a lot about fixed rate terms, short fixed rate terms. So, anywhere from 1 to 3 year terms has been the product of the year to a degree. I mean, it's really pretty much primarily what we've been seeing get funded. The variable rate mortgage has almost been non-existent. Now, if we're near the end, I would assume a lot of people are sitting here thinking okay, I got a renewal coming up. We're near the end. Is now maybe the best time to consider a variable? And if we are truly at the end, it absolutely would be the great time to consider that variable rate. And so why don't we just chop that up for a little bit? Looking at options and where things are at, where do you guys sit on that front?
I mean, I personally sit in a variable rate, so I'm hoping things.
Likewise,
yeah, I'm hoping
hung
things
out for the real last.
Yeah, and I'm sure there's listeners listening sitting in a variable rate and hear us talking about suggesting taking a variable rate. They're probably punching their phone or their speaker because it's been an absolute shit kicking the last 18 months. But there is a really strong base case today, if we are at the peak, to take a variable rate, because just like we've been punished the whole way up, you get rewarded the whole way down, right? And your variable rate today might be priced out similar, if not cheaper, than a shorter term fixed rate, with the upside that you would ride the wave back down. So yeah, like it's obviously not for everyone. The conversation I always have with my borrowers, if they come to me, it's just like, well, if you're telling me you've got baby number 3 on the way, you're about to go on maternity leave, maybe this isn't the right product for you. But like if I'm looking at what I would borrow today, yeah, like if it's not a shorter term fix, it would be a variable rate simply for all the features that it offers. And if we are at the peak, and that's this hypothetical scenario, like there's no real strong case to go really long with a fixed rate. It's jumping into variable and riding that wave back down.
Yeah, I mean, and to touch on the actual interest rates that you can expect, and this is case by case, like not everyone's going to qualify with specific lenders or for specific programs, but the cheapest insured variable in the market is currently prime minus 1.2, which is 6%. The cheapest conventional, which is like a 20% down, owner occupied, you're looking at prime minus 80 to prime minus 90, which is about 6.3 to 6.4. So I think that's another consideration in all this outside of your personal situation, like Tyler touched on. But if you're looking at going with a 2-year, like a 2-year would probably, in my opinion, be a pretty good play, like from a timing perspective. But you're probably not getting anything cheaper than like 6.9%. So if you compare that to a variable at, call it 6.4, worst case scenario based on what I mentioned, and keep in mind, that's actually the cheapest in the market. That's not offered by a lot of lenders. But if I was to look at that and say I can take a 2-year at 6.9, 2-year fixed, or a 5-year variable at 6.4, I would take the 5-year variable all day because you've already priced in 2 Bank of Canada rate hikes. If they were to increase further, like you're already starting at 0.5% below. So, to me, it seems very unlikely that the Bank of Canada will do that. But even if they did, you're with 2 more rate hikes, you're just matching that fixed rate offer. And then, as Tyler mentioned, when rates do start to come down, hopefully next year, like they've talked about, you're going to start to get an immediate benefit on that. And most variable mortgages you can convert to a fix. So, a variable is something that you're really not comfortable with, but obviously you're benefiting on the way down. When they eventually land at a certain point that you're comfortable with, you can always call your lender and lock in. Most of the time in those situations, when rates are coming back down, variables typically still going to be cheaper than fixed. So you might not actually want to do that because it's probably going to bump your rate up. But yeah, my opinion, and my personal situation, if I was taking a mortgage tomorrow, if I could get the rates that I just touched on, I would go variable.
It may be too early to consider a variable given, the sensitivity of where we're at in the market. Is this actually the end? Just having the consistency of the fixed rate mortgage for say 1 or 2 years could just be the peace of mind that's worth paying a little bit extra, which has been a lot of people's mindset all throughout the year. So just to play the opposite side of that, like, if there's any indigestion or concern where you're at, where the market's at, just want to really know and understand what your budget's going to be over the next year or 2 years, then again, that short fixed rate term may still continue to be the product of choice going forward for the next 6 to 8 months. So we'll keep a close eye on that. But I would have to agree, if I was choosing to get into a new mortgage today, I would be leaning towards a variable, just given where we're at in the market.
I totally get that, right? Like, and that's something as like mortgage professionals, we certainly all learned over the last 18 months is just like the value of sleeping comfortably at night, not worrying about your rate. Like that really came to the forefront these last 18 months. So yeah, it's always down to your personal situation, and just really taking a long look at all of your options. And that's definitely something we're doing with all of our clients right now at Thrive. I mean, on top of requesting like repricing on existing approvals, we're always having those detailed conversations with our clients about term selection and how to best play a possible change or turn in interest rates.
Yeah, I guess just from a product perspective, like it's always a very tough decision for probably 99% of people to pick fixed or pick variable because you don't really know where things are going, and there's risk in both. There's pros and cons. There are certain lenders where you can actually break up your financing into multiple different blocks. So if you were really torn, like you could look at doing 50% of your financing in like a 2-year fixed or 3-year fixed. You could do another portion of variable. You could do another portion of home equity line of credit. Again, not every lender offers that, but just something to keep in mind for someone that's really torn and you can't make a decision. There are products out there that allow you to kind of have the best of all worlds and mash them together.
Yeah, we touched on a lot here. And just to kind of wrap up and continuing with this narrative change, there's a number of really strong articles out there suggesting that what we're talking about is correct. We are pretty much at the end here, and we're going off of a really great blog post that actually Tyler had spent some time putting together over the last couple days, and this will certainly be shared as part of this episode. So if you're listening along, I definitely recommend having a read and just to kind of repeat what Tyler said. Like, if you're not somebody that's subscribed to our newsletter or getting this type of content, I highly recommend it. It's really strong content. If you're interested in this stuff and following the market, I highly recommend it. And there's some really good links to articles that I would suggest having a good read on and just getting a bit more comfort of where we're at and what we're talking about here. And so probably just wrap it up there, unless either of you guys have anything else to chat on. I mean, I feel like we did a really great summary of what's going on right now, and what are some of the major events that we touched on in the earlier episode or earlier parts of the episode, and why the weak economic data and where things are ultimately going. So yeah, with that, unless either of you guys have something to add, I think we nailed it.
Obviously, we have a vested interest in rates coming down. It's our business, right? But part of the genesis of this blog and really this podcast episode was just seeing the narrative somewhat change in the media. It's been like 2 years of just like rates are going to the moon, and there's a lot of very consistent articles coming out suggesting that we are at the peak. Rate cuts are coming. Maybe they're coming sooner. So I was just going to echo that. But other than that, I think we kind of said all we can say. Let's tune in to the next one.
Cool. So just with that, we do have a couple more episodes here to wrap up the year. We're going to be coming back with actually one of our most popular topics that we've done over the years, our seasonal topic of a year in the review. I mean, there's been a lot. This has been one of the most wild years of my career in this industry, dating myself back almost 12 years now in the industry. Definitely one of the most, definitely easily one of the toughest years. And we're going to certainly touch on all the events that occurred this year. And so we'll do that with our year in review episode, and we will have some prediction episodes for 2024. So we're really looking forward to just wrapping up the year on a good note, some good content coming. And we look forward to all your feedback. So if you have any suggestions, please don't hesitate to reach out. We're always listening. And lastly, and most importantly, if you have any suggestions for us in regards to future content, please don't hesitate to reach out. So thanks for listening and have a great day.